Hello everyone, welcome to today's video. On today's video, I'm going to talk about two very important concepts. These are fiscal policy and monetary policy. I'm going to talk about the specific tools that the government and the Central Bank of India have in order to influence or improve the GDP of any country. This video will give you good insights into why the government or the central bank have to intervene in the free market. This video will also form a precursor to the next video where I'm going to talk about the different shapes of recovery and what does it mean when Mr. Raghuram Rajan says that India should be cautious of a K-shaped recovery. Stay tuned till the very end of this video because it will give you good insights into what is happening in our country at the present moment. Just a quick introduction about myself. I'm Ayushi. I'm an Indian Economic Service Officer and I'm currently working with the Government of India. I have worked at the intersection of economics, finance and public policy for the last 7 years. I've also done my BA Honours Economics and Masters in Economics. So let's start the video. First things first, what is GDP? GDP is the economic barometer of any country. GDP measures the economic activity of any country. If I have to put it in a simple statement, then GDP would be the total value of all the goods and services that are produced in a country in a specific time period. This is the definition of GDP. I have discussed how GDP is measured and whether it is actually a true indicator about the well-being of an economy in my previous video. I have linked it on the top. Do go and watch it. Now, the important question to ask here is, why does GDP fluctuate? Why does it increase, decrease, and why does this GDP economic cycle happen? Well, the answer largely depends on the demand and supply of different goods and services. Let us assume that the demand for goods and services falls. This means that people are not demanding goods. Why would factories and industries produce goods and services if there is no demand? They would not. And hence, the production of those goods and services will fall and GDP would also fall. Similarly, if the demand is high, then factories and industries, in order to cater to that demand, would start producing more and the GDP of the country will start rising. This is why GDP fluctuates in very, very simple terms. Of course, there could be other factors also, but I have tried to keep it very simple. But the next question that you're going to ask me is that why does demand and supply in any country fluctuate? Well, it could depend on a lot of factors. For example, when in 2020, the pandemic hit India and there was a massive lockdown, people stopped demanding goods and services. They were only buying essential items. There was no demand for electronic items. There was no demand for travel. People were not eating outside and hence overall aggregate demand fell. When the aggregate demand fell, factories and industries did not have any incentive to produce more and the production also fell. Correspondingly, the GDP of the country fell. This was not a scenario which was only in India. It was a worldwide scenario and it was happening in a lot of countries and hence the overall world GDP fell. Similarly, when the demand for goods and services rises, this could be because people have more money, more purchasing power, they have more cash in hand and hence they're asking for more goods and services. Then correspondingly, factories, industries, they will start producing more to cater to that demand. And hence the GDP of that country will start rising. And hence we see a rise and a fall and a rise in GDP of any country. This is also termed as economic cycle. I have made a video on economic cycle previously. You can always watch it to understand more about how this economic cycle functions. When the GDP falls for 2 consecutive quarters in a year, then it is termed as recession. If this GDP fall continues over a prolonged period, it is termed as depression. In such a situation where the GDP is falling, where there is not enough demand, factories and industries are not producing goods and services, this also means that there is not enough employment because if the factories are not producing goods and services, they would also want to cut down on their cost and hence they will lay off the workers and unemployment would start rising. People would not have jobs and hence they would also not have money to demand more. This goes into a spiral. Less demand means lesser production by factories. This means that the unemployment is high. This means that people do not have cash in their hand and they hence start demanding less and less. This goes into a spiral. And this is when the central bank and the government intervene in order to prevent this spiral from happening, in order to improve the GDP again. Now, there are 2 specific policies. The first policy is called as fiscal policy. Fiscal policy is what the government adopts in order to prevent the fall in GDP or in order to improve the GDP. If you recall, then I discussed that GDP is a summation of private household expenditure, private company expenditure, government expenditure, and the net exports. So here I'm talking about the G term. Increasing government expenditure or fiscal policy in more general terms is also associated with Keynesian economics. John Maynard Keynes was an economist who believed that increasing government expenditure would reboot the economy and the GDP will start rising again. How does it work? If government starts investing in infrastructure development, for example, it starts building more hospitals and more schools, then that would also mean that it would employ more people. When it employs more people, people have jobs in their hand, people have money in their hand, they start earning more, and hence they start demanding more. This means that the aggregate demand in the economy increases. When the aggregate demand increases, factories start producing more goods and services. When they have to produce more goods and services, they would start employing more people and people would get jobs, they would get incomes, and overall demand of the economy increases and hence GDP of the country increases. This is how fiscal policy largely works. Let me give you an example. For example, MG-NREGA, that is Mahatma Gandhi National Rural Employment Guarantee Act, is considered to be a classic example of Keynesian economics. In MG-NREGA, government guarantees 100 days of employment to those who do not have any kind of job. This means that people can actually work for 100 days, they can earn some income, they can meet their basic sustenance, and they can also start demanding more goods and services. What kind of activities are they involved in? They're usually involved in rural and agriculture related activities. For example, digging of trenches, for example, constructing of toilets, and so on and so forth. Now, there is, of course, a lot of criticism around this particular policy. Fiscal policy may not always be the most suitable policy. However, having said that, it has been proven over time that fiscal policy can act as a very, very effective tool in order to improve the GDP of a country, especially when the country is going through a GDP fall. Now, let us discuss some of the pitfalls of fiscal policy. The first pitfall is related to crowding out. Let me explain crowding out in very, very simple terms. In order to spend money, the government has to borrow money. How will it finance its spending? It has to borrow. So it will either borrow from the public or it will borrow from the external institutions. Let us assume that the government borrows from the public. So how does it borrow from the public? It will sell bonds to the public and in return, people will actually give money to the government to spend on infrastructure development. Public has limited money with them. So that means when public is giving money to the government for financing infrastructure development, public cannot be giving money to the private sector companies. This means that when government is borrowing from the public, private companies may not be able to borrow money from the public through private bonds or through any other external means. This means that government expenditure may lead to a fall in private investments. And hence, this is the first drawback of fiscal policy. This has been observed in certain countries at certain times, and a large amount of government borrowing from the public may lead to a reduction in private investments. So if GDP is a summation of C plus I plus G plus net exports, if G is increasing and I is following, GDP may not increase proportionately. The second pitfall is related to the overall time lag. Infrastructure development is a long process. Building a school or building a hospital may take several years, and hence by the time the actual effect on GDP is seen, there could be a very, very long duration, and hence fiscal policy may not show immediate effects. That is the second pitfall of fiscal policy. Now coming to the second part of the equation, that is the monetary policy. How does monetary policy work? I've also discussed this on my previous video on interest rates, where I discussed how the central bank of any country and RBI in case of India can influence interest rate in order to boost the demand in any economy. The basic tool of monetary policy in India specifically is what is called the repo rate. The repo rate is the rate at which the RBI lends out to commercial banks. If you haven't watched the video, then do watch it because it will give you a thorough understanding of how the monetary system actually works in India. If there is a reduction in the interest rate, then people are incentivized to borrow more. If they can borrow more, they also start demanding more. Similarly, companies can also borrow more because the interest payments reduce And hence that means that they can produce more goods and services and the overall supply also increases, and hence correspondingly the GDP of the country increases. This is the primary tool that the central bank have in their kitty in order to influence the GDP of a country. Similarly, if the demand is extremely high and the supply is not able to match with the demand, then that means that there is too much money chasing too few goods, then that leads to a price rise. And hence, in such a situation, the central bank increases the interest rate. When the interest rate increases, the demand starts following because people find it extremely expensive to borrow from the banks. Similarly, companies also reduce the borrowing because they find that they have to pay higher interest, and hence the overall demand falls, the overall supply falls, and inflation can be controlled. This may mean that the GDP also falls correspondingly, and the central bank has to find that delicate balance between ensuring that the price rise or the inflation is at a comfortable level. However, the GDP is also not affected. The final part of this video is about which policy is more effective. Whether fiscal policy is more effective or monetary policy is more effective, the answer is it really depends. Both policies can be effective depending on the situation. For example, fiscal policy may lead to more infrastructure development, and any creation of asset may give returns in the long term, in the longer horizon. So, over a period of 15 to 20 years, creation of infrastructure can actually prove to be more beneficial. If there are more schools, if there are more hospitals in the economy, then that can have long-term benefits. Similarly, monetary policy can be very, very effective in the short run. For example, if there is a sudden price rise, if inflation is there in the economy, then monetary policy can act as a very, very quick tool to reduce the inflation. Similarly, if the MSMEs or industries in a country are facing sudden financial constraints, then reducing the interest rate or reducing the repo rate and effective monetary policy intervention can act as a great tool to improve the financial condition of these sectors. For example, in 2020, when the pandemic hit India, there was a sudden downfall in the demand, there was a sudden downfall in supply, and government and the central bank, that is RBI in India's case, they took effective fiscal policy tools and effective monetary policy interventions in order to boost both demand and supply. For instance, government started giving out cash to people in order to improve their purchasing power so that it could lead to an increase in demand. RBI, on the other hand, reduced the interest rate in order to provide incentive for the MSMEs and the factories to borrow more and improve their production capacity. And hence, a balance of fiscal policy and monetary policy may be required in order to improve the GDP situation of any country. The bottom line is that each of the policies can have its own benefits and its own disadvantages. It really depends on the country. It really depends on the situation which the country is in order to decide which policy would be more effective. No policy is right or wrong. It really depends on the situation of the country. I hope with this video you could understand what are the tools that the government and the central bank have in their kitty in order to improve the GDP of the country. What is fiscal policy? What is monetary policy? This was a very, very simple breakdown of the two concepts, and this will give you a better understanding of these terms when you hear about these terms in the news. With this, I close out today's video. On the next video, I'm going to talk about different shapes of recovery and what is a K-shaped recovery, which Mr. Raghuram Rajan recently talked about. I'll see you on the next video. Till then, stay safe, take care, bye.